from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Twitter is shrinking. Elon Musk laying off half the workforce, around 3,700 people, as he restructures the entire company. Meantime, brands continue to mull ads on Twitter, and Musk is doing away with policies like a once-a-month rest day and more. Plus, self-driving technology under the regulatory microscope as we inch closer to a future with driverless cars. We talk about the challenging road ahead with Aurora CEO Chris Urmson. And another tough day for Peloton after revenue fell way short of expectations. Still, CEO Barry McCarthy is confident his turnaround plan will work sooner than expected. We will discuss all of that in a moment, but first I want to get a look at the markets and bring in our Ed Ludlow. Ed, walk us through the day.
Yeah, pretty furious part of the earnings season we've got to. Some of the smaller tech companies, not the mega caps we used to, but Block, the company formerly known as Square, actually pretty impressive quarter from them. This, of course, is Jack Dorsey's other company, the one we've been talking about, less, up 10.5% in after hours. A strong basically performance on the bottom line, gross profit coming in above the street's expectations. The Cash App, which is what Block users use to transfer money or buy stocks and cryptocurrencies, also registering a strong growth on the bottom line. Then you look at DoorDash, wow, up 13%. This is not the story we were expecting. A strong beat in revenue in the quarter. No signs that inflation is deterring the consumer from spending money on takeout, Em. I don't know about you. I've not been doing much takeout recently. I'd love to, but most consumers apparently are. Coinbase, also a mixed bag in its earnings, up 3.7% after hours. PayPal, really the laggard, down almost 7% in after hours trading. Revenue during the quarter did gain 12% to $6.85 billion, which is slightly ahead of what the street was looking to, but it's the full year outlook that the street zeroed in on. Revenue will be $27.5 billion below what the street was expecting, $27.85 billion. Away from earnings season, really the markets of the day were all about the Fed. We know what the Fed did Wednesday, raising rates by 75 basis points, and the commentary that rates will remain higher in the face of stubborn inflation. The market is talking about recession fears. NASDAQ 100 down for a fourth consecutive day at its lowest level since July of 2020, down 2%. The Philadelphia Semiconductor Index, or SOX, also weaker as yields continue to push higher. What was the craziest story of the day? It was Peloton. Let me take you on a wild ride, Em. We opened down 16% on Peloton after the company said revenue in the last 3 months of this year would be between $700 million and $725 million, well below street expectations. The chart on your screen tells the story. We closed up 8%. So we were down 16%. We closed up 8%. That is a big hill climb. You know, even more impossible than some of the hill climbs in the Peloton classes that you and I have been taking over the last 2 years, Em. A really astonishing story. Beyond that, some breaking news crossing the Bloomberg terminal after hours. And yes, more names freezing their advertising on the Twitter platform. General Mills, Audi, and Pfizer all pausing Twitter ads, according to a report from Dow Jones. Little reaction in the stocks or the US-listed shares of those companies. But this adds to the report from Bloomberg last week that General Motors has paused ads on the platform. You'll remember that L'Oreal issued a statement earlier in the day saying they had in fact not paused their advertising on Twitter after a report overnight from the Financial Times which said they did. Either way, advertisers are trying to work out what is going on inside of Elon Musk's Twitter.
All right, Ed Ludlow, thank you. Lots to digest there. I want to dig into those layoffs that Bloomberg has learned will happen at Twitter. Musk planning to lay off about 3,700 people, half the current workforce. Our sources telling us he plans to tell the workers who will be affected on Friday. Bloomberg's Kurt Wagner, of course, critical, along with Ed, to our reporting on all of these latest Twitter developments. Kurt, where are these jobs going to come from? What do we know?
Yeah, I mean, this is company-wide. It's not necessarily going to be in any particular area. Well, the one thing that Elon has kind of stressed is that product and engineering seem to be where his focus is. So it's possible that, that might be a little bit less impacted than something like, trust and safety or policy, legal, things like that. But, this is a part of his strategy to try and get the company into a better financial situation, right? He paid $44 billion for Twitter. They now have these huge debt payments that they're going to have to start paying off, or these interest payments. And, part of his plan is let's cut headcount.
So how are Twitter employees feeling right now? I mean, the axe is going to come down on Friday and nobody knows if they're going to be cut yet?
That's exactly right. And they're not only that, Emily, they haven't heard from Elon Musk at all since the deal closed. They haven't heard from any other leadership, right? Everyone's kind of talking with their managers, but there's been no company-wide messaging at all. All of the C-suite, CEO, CMO, CFO, all of those folks were fired last week or early this week. So if you're an employee at Twitter, you're getting your information from places like Bloomberg or from other media outlets, right? And that's where you're finding out what's happening at your own company. And so that's quite unsettling for a lot of people, especially when you're sitting around wondering, am I going to be employed by the end of the week? So this is a stressful time internally, to say the least. And a lot of employees we're seeing are sort of looking out for each other, trying to give best tips on what happens when you get laid off. Hey, let me make references for you, that kind of thing. They're trying to take care of each other because the company doesn't seem to be doing it for them.
Meantime, we've just got this headline from Dow Jones that a number of pretty prominent advertisers are pausing ads on Twitter. I mean, do you think that this is going to become a bigger thing? I mean, we talked about the potential for a boycott. Does it get to that?
Well, this is what I think we were talking about yesterday, and I think that the chance of a boycott not only seems possible, but I do think it seems like a really big deal. And again, it's because the time we saw this happen with Facebook, all the key executives, the Sheryl Sandbergs and those at the top of the company on the business side, they went out and they did damage control for days, right? And we're just not going to see that at Twitter because all the people at the top of the company are gone. And so when you have these big advertisers, and Twitter is very much a relationship-driven advertising business because they don't have that, very intimate direct response type stuff. When you have these big advertisers really being cautious or putting things on pause, you don't have the people inside of Twitter to necessarily go to them and reassure them like some of these other big ad companies might. So I think it's a dangerous thing that's happening here.
And tell us a little bit about what we know about how decisions are being made on the inside, who's making the decisions, and how things that are being communicated are actually being communicated.
Yeah, well, we know that Elon is making the decisions, right? And the best I can tell is that a lot of things are being done very quickly and sort of haphazardly, right? I mean, even this change, they're going to raise the price of their subscription product to $8, and they're going to add some new features, including the blue check verification. We saw him sort of like workshopping this publicly on Twitter, right? He's like tweeting, hey, would you pay for this? How much would you pay? What features would you want? And then all of a sudden he just announced it the next day. And so we're seeing there's a very small group of folks, including some venture capitalists, who are sort of advising him here. But really it feels like Elon is sort of, kind of making this up as he goes along. As I mentioned, there's not a lot of messaging coming from the top of the company at all. So unless you're in a particular group working on a specific problem for him, you don't really know what's happening at the company.
All right, Kurt, I'm going to let you get back to working the phones, Signal, your Twitter DMs, and all of the ways you're breaking all this news. Bloomberg's Kurt Wagner, thank you for the update. Coming up, why Silicon Valley is on a post-pandemic healthcare spending spree. That's next. This is Bloomberg. Last month, the venture capital firm CRV announced $1.5 billion in funding across two funds, which means more dry powder to take advantage of low valuations. But how are firms thinking about how to deploy all that cash in a potentially very long downturn? Kristen Baker-Spone is a general partner at CRV and joins me now. Kristen, how is CRV's strategy evolving in the midst of this downturn? What are you all talking about around the partner table?
Around the partner table, we're talking about how we're continuing to play to our strengths. CRV has been in business for over 52 years and focused on backing founders at the early stages. We raised $1.5 billion, as you mentioned, to continue to do that and invest at the earliest stages, partnering with founders that are building game-changing companies.
So are you waiting for valuations to come down, and are you finding enough places to put that cash, given so many companies out there are struggling?
We're seeing valuations compress across the board. You even just mentioned some folks out in the public markets that are seeing valuations compress. And we're seeing that play out again across the private sector as well. That being said, at the early stages, we're backing founders that are in this journey for the long haul. And as someone who focuses on health tech, healthcare isn't completely recession-proof, but it's definitely a defensive place to be in the market where there's continued to be spend and innovation and technology adoption.
So let's talk about health tech, because I know that's your focus. Is it as cool as it was in the middle of the pandemic or not?
Well, I continue to think it's very cool. That being said, I think that there was a really interesting, we had a watershed moment during the pandemic where there were a number of trends that were already happening across, whether it's consumerism in healthcare, adoption of technology, bringing AI into healthcare delivery, that the pandemic helped unlock. And that activation energy and that pent-up demand was released. Now, as the market has cooled, we're continuing to see those trends play out, but at a much more reasonable pace of technology adoption. A few companies that I'd highlight, one being a company, Wheel. You just had the logo up on the screen. Wheel is in the telehealth and marketplace space, where it's helping unlock telehealth for large tech companies, for large providers, as well as for companies that are trying to put great care in the hands of consumers like you and me.
So what is it about health tech that, specifically excites you? We have Apple coming into this, Google, Amazon trying to get in to health tech. Is that a threat that big tech giants want in, or is that an opportunity?
I think it's an opportunity. We're seeing a number of large players come into the space. You mentioned Amazon buying One Medical. We're hearing rumors of Apple getting into the health insurance game. We're seeing Google continue to play in the data space. I think it's a recognition of how technology has been in healthcare a bit of a laggard industry. And there's so much opportunity to bring healthcare into the hands of not only clinicians, but also individuals like you and me in order to bring us the care that we need when we need it. So many of us, for the very first time during the pandemic, did at-home diagnostics, had our first telehealth visit. But there's also a huge opportunity to drive better efficiency in the care delivery system across the board.
Meantime, more broadly, the world is falling apart and Silicon Valley is kind of crumbling. We've seen layoffs across the board. We just talked about 3,700 people about to lose their jobs at Twitter. Does this have broader ramifications on the startup ecosystem?
There are definitely broader ramifications across the startup ecosystem. And that's why, the breadth and depth of the firm like CRV, where we've partnered at the early stage, but also seen a number of different ups and downs in the market. And this is where, we're seeing leaders make really tough decisions. And the leaders that are making tough decisions are focusing not just on growth. Growth is necessary, but not sufficient. How are they focusing and investing in their companies and in the future R&D, as well as the growth to drive scalable business models and build the game-changing companies that we're excited to continue to back?
So what advice are you giving startup founders right now, given these tough market conditions?
As a board member and a partner to many of the founders that I work with, I'm trying to help them see around corners and see what's coming down the pike. And I think one of the key things that founders are focusing on is not just how can they have clear eyes and continue to focus on their business, but also make the tough decisions. Oftentimes it can be tempting to continue to want to see the world play out. But what I see are those founders that are making the tough decisions with clear eyes, with advice from their executive teams, as well as their investor partners, are going to be the ones that can not just weather the storm, but hopefully emerge even stronger.
So talk to me a little bit then about the founders you think that will or can be successful at a time like this. I mean, people are calling this, .com bust 2.0. I mean, this could go down in the history books as a tectonic shift in, the industry, the companies that survive and the companies that do not.
We continue to focus on backing not only passionate founders, but Emily, you just mentioned how tough the times are. The word that comes to mind is grit. Our founders and companies that can be gritty and not just, as I mentioned, move through this time, but potentially emerge stronger. I also look for founders that are beacons for talent, that'll continue to be beacons for customers and for capital, even in the tough times. I think we're going to continue to see investment in really high quality teams and really high quality businesses. Those aren't going away. What we're seeing is that flight towards that really high quality where there's growth, but also efficient growth to building these companies.
And I know, you also worked in banking, you helped take some companies public. What is your sense of how long this downturn lasts? How long are we in for here? Is it 6 months? Is it 18? Is it 3 years?
Well, I am continuing to be continuously optimistic that we'll make our way through. That being said, planning for a bit of a stormy weather ahead. So, your guess is as good as mine in terms of how long this will last. But I think we're continuing to invest in companies and work with founders that are seeing not just a brightness on the horizon, but hopefully continuing to work through these storms. My guess is we're going to be in this for a considerable amount of time. And so having folks that are going to continue to focus on the fundamentals of their business, keep the main thing, and build towards the future.
All right, keep the main thing. We'll remember that. Kristen Bakerspoon, General Partner at CRV, thank you so much for stopping by. All right, coming up, Peloton continuing to struggle, but the CEO still upbeat. We'll explain why next. This is Bloomberg.
Season is here.
The earnings are starting to pour in.
The numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going across the wire.
A big beat.
Stock is up more than 8%.
Coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch?
That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Peloton rebounding after tumbling earlier, with the company posting a weaker forecast than expected, even as the CEO declared it's beating its own timeline for turning the fitness company around. Joining us now, Bloomberg's Mark Gurman. Mark, talk to us about what's going on here. Investors clearly don't like what they see.
Yeah, what we got this morning was the definition of a mixed earnings report, or PR putting its fingerprints over some numbers here. So if you look at the numbers, things are not so great. You're seeing a revenue forecast to decline about 37% in the current quarter. That's the second fiscal quarter for Peloton. On the other hand, you have a letter from Barry McCarthy, Peloton CEO, saying that the ship is starting to turn. That is my impression as well. You are seeing some positive direction happening in some of these numbers. Gross margins have improved over the past couple quarters. Free cash flow has improved. What we don't like are the revenue numbers specifically for hardware. Their hardware revenue numbers continue to fall, while their subscription numbers continue to climb. The good news there is you see usage is continuing, churn is very low, subscriptions are continuing, but people are not buying the hardware. To me, this raises the question, why is Peloton in the hardware business at all, right? Why not completely pivot the company away to putting its tablet on third-party bikes? As we know, Peloton probably has the best content, probably has the best software. in the hardware bike and treadmill space, why not just get rid of your failing hardware business and make a really big subscription business? So I think that's where the company may eventually go. So clearly some really bad news on overall revenue, but some good news in terms of how the company is framing what it's calling a turnaround and on the subscription front.
How do we measure whether the company is really beating its own timeline? Do you agree?
I mean, there's really no way to measure if it's beating its own timeline. We have to take their word for it, right? Barry McCarthy says his timeline was longer than the 1 year he says that, this has taken, right? Remember, he joined in February, and he's really pulled the company apart. You've laid off thousands of people already. You've outsourced manufacturing. You've outsourced customer service. You've outsourced deliveries, right? So they pulled every lever possible. They've run the company into the ground and really starting, trying to start over. But we don't see the positive impact there on the stock. Obviously, they're down, over 90% at this point in the last year or so. But you are seeing some positive comments and positive momentum. They're really talking up subscriptions. Subscriptions are now well over 60% of their overall revenue, right? Which obviously wasn't the case at their, when they were high flying at the, the top of the pandemic. So I think if they continue to move the needle on subscriptions, they really try to compete with Apple Fitness Plus. They really try to integrate with bundles between hardware and software, and ultimately maybe exit hardware, something that I speculate they should do, not something they said they would do. I think they, could be on solid ground for a little while.
Quick question. What about an acquisition? Amazon, Apple, would they ever buy Peloton?
I don't think Apple would ever buy Peloton. They have Fitness Plus, they have the Apple Watch, and really you would be buying their hardware business, which is, failing at this point. Amazon, maybe for Prime. I really think Netflix has not done a good job in expanding beyond their core content. They've really failed in gaming. They should probably try to get into music as well. But fitness, that could be a big way to lock people into Netflix subscriptions.
All right, looks like some CEOs have some consulting to do with Mark Gurman. Mark, thank you so much for joining us. Always appreciate you stopping by. Coming up, self-driving technology getting more and more scrutiny from regulators around the world. After the break, we're going to talk about the challenges for autonomous driving with one of the leaders in this space. This is Bloomberg.
Season is here.
The earnings are starting to pour in.
The numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going to cross the wire.
A big beat. Stock is up more than 8%.
Coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch?
That's where the rubber hits the road for Goldman Sachs.
Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. I want to get back to the markets and names across EV and mobility on the move. Here's Ed Ludlow back again. Ed?
Yeah, Nikola is where I was spending my morning. It was really interesting. The stock up as much as 11% and then ultimately closing down 11%. Pretty reasonable performance in the corner, very modest revenues. But what spooked the market was, in fact, they are not going to reach their original guidance of 300 battery electric semi-trucks this year, and actually sort of downgraded the outlook for the rest of the year and next year, saying that performance is not going to be as good as they hope. Their expectations are being lowered because customers for battery electric commercial vehicles are pulling up back. They're basically saying that the cost is too high right now, the charging infrastructure is too high. You look at that chart and kind of the wild ride that we had for Nikola throughout Thursday's session. Two others in that space as well. Fisker also sliding after it reported a loss, and RBC cut the stock to sector perform. I think there's a lot of interest in Fisker given that they plan to start production of their SUV this month. Of course, it's built by a third party. And then you have Aurora Innovation, more focused on the autonomous driving space. This is a very much a pre-revenue company, but with some fighting talk. They are capitalized to get them through 2024, and Aurora telling investors that from 2024, they're on track to launch this commercial autonomous trucking business. Fighting talk. The stocks seem to like it. Is fighting talk enough? I think there's a lot of questions in this space right now.
All right, and hang on. I want to stick with Aurora and the future of autonomy. Aurora giving some fighting talk about the real-world prospects for self-driving tech, but the industry is having a rocky patch with competitor Argo AI shutting down after Volkswagen and Ford walked away from backing that deal. Is it the first crack in a bigger fissure in self-driving technology? Aurora's co-founder and CEO Chris Urmson is with us now. So Chris, what do you think? Is it?
Yeah, I think it's just normal, right? What we're seeing right now is what happens in any industry, that if you look at the automotive industry at the beginning of the 20th century, there was 250 car companies. By the 1930s, there was 3. And so we've seen a lot of companies kind of spring up, explore this space, and some of them are going to succeed, some of them aren't. At Aurora, we've positioned ourselves to be independent, to have the capital we need, the people and the technology. And so, I'm actually more optimistic than ever before about the space and where we're going.
Well, as you say, risk is normal. But if you look at what happened with Argo shutting down, big investors or potential investors pulling out, is that a risk Aurora faces?
No, in fact, it's part of our strategic advantage, right? From day one, we wanted to be an independent company because we knew we wanted to be able to focus on the thing that mattered, on delivering on our mission, getting self-driving technology into the market. When Jim Farley talked about shutting down their investment in Argo, he literally said, we want to place our bet somewhere else, right? So we don't want to be another bet. We want to be the bet. And I think if you look at our investor base, these are folks who get the opportunity, understand the quality of the team, and are excited about the journey we're on.
Chris, it's good to see you virtually, at least. You just said that what we're seeing in the industry is normal, but what VW and Ford were saying is that actually we're pulling out because this is a much more distant technology than we thought. It's too far away right now. What are you doing to ensure stability for yourselves in terms of raising money? Are you going to plan headcount reduction to kind of preserve cash? Because you guys still have a little way to go as well.
Yeah, so I've been in the space for 20 years-ish, so kind of understand how hard the problem is. And again, we engineered the company from day one to solve these important problems, realizing we were climbing a mountain. So as a company, we have amazing partners. We work with, as you've got on the screen here, Volvo trucks. We work with PACCAR, 2 of the top 3 truck manufacturers. We work with Toyota, the world's #1 car manufacturer. Uber, the world's #1 ride-hailing platform, FedEx, Schneider, Werner, some of these amazing trucking companies. So we feel like we're spring-loaded on that front to go to market. So, yep, we raised a lot of capital last year. We're in a very strong position with $1.2 billion on the balance sheet at the end of the quarter. So we're really excited about the path forward here.
Is it possible that Apple or Microsoft buys your company, Chris?
We have, so I think you're alluding to a memo that leaked that I drafted for a conversation with our board. And so I don't know whether it's possible or not. We're not going to comment on those kind of things, but I think for any company in the existing market conditions, you need to be exploring the span of options from, as you said, headcount reduction, acquiring companies using, like they talk about a crisis being the worst thing to waste, through focus. And as a company, that's what we've taken, right? Is the path, okay, we're going to focus on getting the trucking product to market. We're going to be more efficient where we can be with the capital we have on hand. And we're just going to execute through this. And we have the capital to do that. And we have the team and technology to make it happen.
Chris, when you and I last saw each other, we were in Texas riding around in self-driving semi-trucks. Do you remember that? But your original ambitions for Aurora were broader than that. It seems like very much the focus is on the use case of trucking, delivery, haulage. Have you had talks with some of the big players in that space, like Amazon, like Walmart?
So we are still building a platform that will drive all kinds of vehicles. The right first place for us to deploy the technology is in trucking. We see the opportunity, the market need is there, the economics are there, the market scale is there, right? It is just the right place to deploy this first. But we have those partnerships with Toyota and Uber that spring-load is when we get to ride-hailing, which will be our second product in the space we expect to be, to go charge into that. And yes, we have amazing partnerships, right? FedEx is the largest carrier of less than truckload loads in the U.S. And it's also the most tractors and trailers of anyone in the U.S. So we're working with some amazing folks today.
talk to us about the longer term, beyond trucking. Where could this technology go, and how long is it really going to take? Because, much of our coverage recently has been, we've been talking and talking and talking about this. You said you've been in this industry for 20-ish years, but it still hasn't fully come to fruition.
Well, we're at this point. So one of the challenges with our technology is we get to develop it like out in the public because we're on the roads and people see it. So I think you get to see a little bit more behind the curtain of what it takes to actually develop a game-changing or world-changing technology. I think it's really exciting to see some of our competitors have vehicles on the road with no drivers in places like in Arizona and in San Francisco. We're on the road every day with our trucks hauling loads for our customers. And so that's exciting. And we're looking forward to the next 2 years. And we've been a leader in transparency. We've shared our roadmap from here to the launching the product with an operator. And we want to continue to do that to build trust through what I think of as the current valley of disillusionment.
So can you give me a number? How long until long-haul trucking is truly driverless?
Yeah, so we've shared a roadmap for us. At the end of Q1, we're working towards having the Aurora Driver be feature complete, which means it does everything it needs to be able to drive, just not yet well enough. By the end of next year, we're working towards having the Aurora Driver be ready, so that if we had a truck platform that had was autonomy enabled, we'd be able to pull the operators out of those trucks and have them operate without anybody on board. And we expect to actually launch in the following year in 24.
Hang on, we're actually getting some breaking news across the Bloomberg from our own Mark Gurman about Apple's hiring plan. Apple pausing hiring for roles outside of research and development. I had talked to Tim Cook earlier this year, and he said they were going to be deliberate in terms of how they cut or where they spend and where they grow. But this is apparently an escalation from earlier budget cuts and a signal of a hiring slowdown. Again, Apple pausing hiring for many jobs outside of R&D. Chris, look, I know Ed asked earlier about the difficulty of the environment, but have you thought about cost cuts? Have you thought about layoffs? It seems like everyone is thinking about it, but everyone's strategy is different. For example, Brian Chesky told us yesterday, to use a car analogy, he said, we're actually stepping on the gas, not stepping on the brakes.
Yeah, for us, we continue to focus on being efficient with the capital we have. That'll push us, the capital we have on hand pushes into mid-2024. We've looked at where can we be doing things sequentially rather than in parallel, and that's one of the reasons why we're focusing so much on trucking. We're not doing cars, but we're going to kind of have that more streamlined off the back of what we do in trucks. We've looked at, through the organization, how can we restructure things to be more efficient? We've made changes to the way people report. We've looked for duplications and simplified those and moved people in different parts of the organizations. And we've looked at, what are the things we need versus what are the things we want? And we're just getting the things we need. So we're being thoughtful. We're extending the runway where we can, but the opportunity is so exciting. The position we're in is so amazing that we just need to charge through this, drive through it.
Chris, will you hire any of those laid off from Argo AI? And give me your big picture take on consolidation in this industry.
Yeah, so absolutely, right? We're always looking for great people. We're hiring people today. We've got a bunch of jobs open. If you're interested, please apply. And we're certainly reaching out to some of the Argo folks. Consolidation is happening. I've said this for years. I've said that, like, when we started the company, let's make sure Aurora is set up so that it can be a consolidator rather than a consolidatee. And it's why we've taken the independent path we have. It's why we've been efficient building the company, why we've raised the capital we have at the times we have. And so, yes, I expect that at the end of the day, there's going to be at most a handful of companies that kind of cross the chasm and deliver a product in that. And we're positioning Aurora to be one of those.
All right, crossing the chasm, driving through it. Appreciate sharing your thoughts with us. Aurora CEO Chris Urmson and our own Ed Ludsow, thank you both very much. All right, coming up, two major power players in crypto just reported earnings, Coinbase and Square, coming up. This is Bloomberg. Coinbase and Block just reported earnings as headwinds for crypto persist. Bloomberg's Sonali Basak dug through the report. Sonali, what are the highlights?
It's a pretty good day when you're looking at these firms. And you're looking at Block, for example, which had already sold off 67% this year. We're coming in with gross profit above expectations. They're really growing their cash out there. I want to kind of hone in here as it pertains to crypto because, of course, we have a very crypto-friendly CEO in Jack Dorsey. Bitcoin revenue was $1.8 billion nearly. While that's down about 3% year over year, it's still up 128% on a 3-year compounded growth rate. So if you're looking at the crypto market and what it means for these fintech firms, it's really not as bad as it could be. And of course, that commitment's still there as they grow those other financial services. Really quickly pivoting here, even the Coinbase, they have really highlighted a lot of headwinds here. You do see that jump here in subscription and services revenue, and that is even larger, that jump. It would be 82% when you hold crypto prices constant. They're really benefiting from net interest income, so you're seeing these firms really leaning on the diversification, Emily, of the businesses here in order to show investors what they're worth. Robinhood, we have to point out as well, because revenue topped estimates, and really, stock-wise, they're down the least of the group here. They're only down about 30% this year. Crypto decreased 12%, but options and equities were up. And cost-cutting is really helping them drop operating expenses down 12%. And you're seeing that help them really come in with an adjusted profit number that is better than expected. They're coming in with adjusted profit that is rather than a loss. But again, can that hold when it's not just on an adjusted basis?
You know, Jack Dorsey, of course, the CEO of Block, has been in the news all year for a totally different reason, given the drama that's happening at Twitter. You know, did we hear from Jack on the call? And, you know, talk to us a little bit about, obviously, he was really instrumental in launching some of Twitter's early crypto projects. You know, tell us a little bit more about the connection.
Certainly, because we know Jack himself has really supported a lot of companies in the Lightning Network, for example, and really tried to integrate it with Twitter. But no, he was available on the Block call. We know he's focusing very much so on Block and financial services. He did not discuss Twitter. A question I would have that's kind of looming out there in the ether is, as it pertains to Block and Twitter, we asked Anthony Noto yesterday at SoFi a similar question, given his former Twitter background, whether these new fintech firms can partner with Twitter in order to expand financial services to create that great super app that Ed Ludlow loves to talk about. So looming open question, and it's yet to be seen. But Noto yesterday certainly did seem like they were open for business. Should that be something that Twitter would explore?
All right, Bloomberg Sonali Basak, thank you. On that note, we just got another headline on the Bloomberg that Elon Musk is asking Twitter to cut infrastructure costs by $1 billion. This on top of more than 3,700 employees that we've reported will be laid off at Twitter tomorrow, and that they will be informed of whether or not they're going to be laid off tomorrow. So again, another headline coming from Reuters that Musk is calling on Twitter to cut infrastructure costs by $1 billion. Okay, coming up, it's been a choppy market for founders, but PitchBook's new report saw signs of resilience from businesses run by women. We'll talk to one of the report's sponsors next. This is Bloomberg. PitchBook just released a report on women in venture capital, found that women founders have posted the second highest deal value figures on record despite volatility. Joining us now, Sarah Chen Spellings, co-founder and managing partner of Beyond the Billion. Sarah, talk to us about the silver linings that you found for women-run businesses here.
Hi, Emily. So good to be here. Thanks so much for highlighting our report once again. You know, the data continues to tell the same story, and I think you've heard this narrative before, Emily, that female founders continue to outperform no matter what the circumstances, despite market conditions, despite their turbulence in the markets. They continue to be resilient, and yet they continue to be underinvested. So while we are seeing higher numbers compared to 2021 with deal value becoming a lot higher in the recent months, what's not sort of on the upward trajectory that we're really looking forward towards is the proportion of deal value and deal count as a whole compared to the whole venture capital. So really a lot to unpack here, from exit value to their performance in general, from even looking at the burn rate of venture capital funding. And there's been a lot of news, as I think you've covered in your last couple of segments as well.
Right. You found that women founders had lower burn rates, greater valuation growth at the late stage versus companies founded by men year over year. What do you think's behind that?
Yeah, this data, people always ask us, are you surprised by the numbers? And the reality is we're not, because women continue to outperform in leaps and bounds. And the reason for that is this. Good news, bad news, they've not traditionally had a lot of funding, and they've had to work with what they had. And that means that they're a lot more resilient. They've planned their cash management, and they're able to weather the storm. And this, guess what? It is a little bit of a funding winter, and the storm is here. And whilst, there will be winners and losers, I think it's clear that women have been smart about planning forward, and their cash management is showing right now, with the burn rates being a lot more manageable. And by the way, as you mentioned, the drop in late stage funding in terms of median valuations that we saw, the crash from the valuations from 2021, which was really, a blockbuster year that we're starting to sort of see unravel now, was really showing how there were a lot of companies that had valuations that were not sustained. And with female founders, they're always a lot more, I wouldn't call it conservative, but they're a lot smarter, a lot more realistic about their projections and what they can do. And therefore, their valuations are sustained. That's sort of explaining the numbers of why the drop hasn't been as much as you've seen for the wider market.
I'm not going to argue with those adjectives, Sarah. Talk to us about the sectors that are seeing the most growth. We were talking about health tech earlier, self-driving tech earlier, and the narrative is different for all of them.
Yeah, well, Emily, the good news is that women continue to innovate in all sectors, right? So, of course, we see the data where there's a lot of growth in retail, in B2B SaaS. In fact, some of the top unicorns that have female founders at the helm were women in health tech and women in SaaS as well. The two decacorns that emerged, so decacorns being, for those who may not be as familiar, multi-billion companies valued at $10 billion. And that's TalkDesk and Deal that really brought the valuation up and sort of the numbers and trends that we're seeing. So we're seeing a lot of growth in retail, in health tech, in fintech and SaaS. And we're excited by, as a whole, for the work that we do with our consortium of funds, over 100 funds across the globe. Women continue to innovate across the sectors despite market conditions. Even if they're in a sector that's being hit hard right now with market conditions, they are pivoting and figuring out what next.
How are dynamics between LPs and GPs changing in this environment? There's a lot of money sitting on the sidelines that venture capitalists have raised. There's not necessarily a place to put it all.
Yeah, Emily, thanks for asking all of that. The LP and GP sort of connection is one that we focus a lot on, right? And I think you've picked that up rightly. Despite what has been said about the fundraising winter, it's clear that there is a dispersion, right? There are winners and there are losers, and there are those multi-billion firms that continue to raise billions of dollars. And, we've got a lot of dry powder sitting on the sidelines, but this is what's happening. LPs are being a lot more cautious, right? The word is we're optimistically cautious about the way forward. And therefore, despite money in the bank, a lot of them are being slow to deploy. So in fact, whilst you're seeing a lot of money being passed on to GPs, this doesn't necessarily pass on to the founders, which is where they're feeling the crunch a little bit. But, the winners will emerge. And I think it'll be more and more important to see founders really emerge in this crisis, right? I think a lot of the big names that you and I know, Uber, Airbnb, all emerged from a time of crisis. And I think this is going to be a good time for GPs that are focused on what next, the next generation companies, to really do the right thing, and LPs have a role to play here.
Beyond the Billions co-founder Sarah Chen Spellings, thank you for sharing all of that with us. Worth checking out the report in more depth if you'd like. Later on the show this week, Friday, Expedia's CEO Peter Kern will talk to us about the travel rebound or lack thereof. This is Bloomberg.